Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hello Lauren.
Hey Curtis, hey everybody.
Hey Lauren, I understand you've been looking at some research studies.
Yes, I've been looking at studies again, and I found one that was actually kind of surprising. It was Vanguard did a report on the usefulness of active management and other sorts of things, which was not surprising. I had seen all those results before. But they did a report on the usefulness of the star ratings at Morningstar.
Okay.
You know, funds give star ratings, and
So just to remind people, a lot of times when you look at, it could be newspapers or Morningstar magazine or online, they have like up to 1 to 5 star ratings of their funds, and 5 being the best and 1 being the worst.
And so one of the reasons this jumped out at me is because recently I've been looking up various funds on Morningstar to find their expense ratios. And you know, even for me, emotionally, I always like it when a fund that I recommend has a high star rating, and I emotionally don't like it so much when it has a low star rating. And so if it affects me, it affects everybody else. But the study that they did shows that this is exactly the wrong way to look at it. I had been telling people for a long time that star ratings were just useless, but I mean I have to modify that. So what they did is they looked at funds back to 1992, all the funds that had gotten star ratings.
Okay.
And then they looked at their 36th month performance following the star rating, so the 3-year performance measured against the index that best represented the fund. Okay. 5-star funds trailed their index by 1.38% per year. 4-star funds trailed by 1.25% per year. 3-star funds trailed by 1.02% per year. 2-star funds trailed by 0.74% per year, and 1-star funds trailed by 0.15% per year.
Wow. So the lower rating, the better performance.
Yeah, that was what actually happened. So the wrong thing to get from this study is to conclude I should go out and buy a bunch of 1-star funds. Okay, that's not a good idea. What the study actually shows, and this is an interesting statistical fact, so I thought it would be a, because this applies to a lot of things when statistics come out that are a little bit surprising. So they were comparing funds to indexes themselves.
Right.
Well, we know that the index itself, not an index fund, but the index itself has no expenses.
Right.
The average mutual fund has expenses of about 1%.
Okay.
So those 3-star funds basically did exactly average. They underperformed by exactly what their expense ratio was. The 1-star funds, see what's really happening there is so many 1-star funds get closed. Mutual funds companies shut down funds all the time. So what you're really seeing in this study with the supposed outperformance of 1-star funds, what you're seeing is survivorship bias.
Okay.
Because the only ones that were still left were ones that had magically had really good performance, even though they got a 1-star. All the other ones, they just shut those funds down, then they fell out of the database. So there was only, it turned out, a tiny little pool of funds with 1-star ratings that were measured. And again, they were usually only measured if magically they had good enough performance that they stuck around. What happened with the 5-star and the 4-star funds is also easy to explain, and it's a lesson that's always applicable to investors. Many of these funds had inflated ratings because in the late 90s they were into tech stocks.
Right.
You know, indexes don't measure based on technology or real estate or the financial sector. They measure based on size, fundamental factors like your price compared to your book value. So a lot of these 5- and 4-star funds, the reason they underperformed is because basically they had gotten their ratings by taking a bunch of weird risks or concentrating in a bubble, and then the bubble burst. So that's kind of what dragged down their performance. And that is just sort of always applicable. The 2 lessons from this study, first of all, that poor performing funds get shut down and eliminated from databases, and second, that brief outperformance can happen just because you're gambling. You know, those lessons always apply to investors, and in the real world, the only way to get satisfactory long-term performance is to diversify, rebalance, and stay the course.
So my challenging question to you to end this episode is, I'm still not clear, is there any really good reason to look at these ratings?
No, none. None at all.
Okay.
They're actually worse than useless.
Okay, thank you very much, Lauren. We'll see you next time on Erickson TV.
All
Bye
right,
now.
see you next time.